Hello and welcome to my weekly stock market review. Well, a very interesting week because if you look at the numbers, they don't tell the whole story. Nifty was down about 0.7%, mid cap was down about 0.3%, small cap was up more than 1.5%, and micro caps were also up about 0.4%. So if you look at it, you'll say nothing great, plus or minus 1% the markets move, but it is a market which this week was challenged on many fronts. Well, the geopolitics continued. On Monday, there was an easing because the previous Friday, if you remember, there was heavy selling by FIs because of some bad news on the geopolitics. Then Monday it recovered. Then again during the week, worse news kept hitting. So oil hit $126 intraday one day. Then it came down, stabilized. It's still at about 109 now. The rupee dollar crossed 95 first time, again eased to 94, 91, but clearly weakening pressure. Bond yields spiked up, partly because the US Fed came with a very hawkish hold. So US interest rate spikes and Indian bond rates also spiked beyond 7.05 to 7.1%. And then you had the effect of the RBI realizing the ECL, the capital adequacy norms on provisioning for loans. Though it's going to be effective in April next year, the market has already started absorbing. So clearly, it was a market which was hit by a lot of news, and then the earnings were also flowing through. Though I must admit that the earnings season has been much better than expected, and a lot of positive earnings have come through. So the reason I said that was if you look at the kind of challenges the market had to face and the results that you saw for the indices, clearly it shows a great deal of resilience and especially driven by retail. Why I say that is, well, FIIs were sellers throughout the week and they ended on Thursday with 8,000 crores outflow. So total for the week about 13,000 crores. DIs were supportive throughout the week. So compared to the earlier weeks when they were a bit hot and cold in terms of waiting for the earnings season, booking profits in sectors, doing a lot of sector rotation. This whole week, DIs were consistent buyers and ended about 3,500 on Thursday, but overall for the week about 11,500 crores. They've almost bought everything the FIs sold in terms of absolute cash numbers. But if you look at the resilience and the small cap performance and the micro cap performance, clearly retail were heavy participants, and hence I would like to label this week as a week of retail resilience, partly, of course, supported by the DIIs. So this, I think, gives you a clue that while FIs were also sellers heavily on that one day, by and large, the market, in my sense, has the worst case scenario of an oil crash, 126, itself shook the market, but not in a very deep way. To some extent, the market seems to have found a close bottom. The second aspect is that DIs have now started buying. So for the coming weeks, as earnings season clarity comes up, I expect DIs also to start putting. So I have my feeling that the markets, while will be volatile, there could be a lot of support from the DIs. And I think retail has shown a phenomenal ability to stick it out despite this volatility and keep buying. Though, of course, they tend to buy a company which does good results, they immediately buy that, and they buy all the other companies in that sector. That's classic behavior, but nothing wrong. But it shows that there is no fear psychosis in the market, and that I would say is good news. FIs will continue to be under pressure because the geopolitical situation affects India a lot, and so they will take. So from the point of view of this week then, if you look at the sectoral indices performance, well, the worst sector was the PSU banks with more than 4% drain. The answer for that lies in two things. One is the bond yield spike hitting expected treasury incomes, and second, the RBI's new norms in terms of ECL, which naturally PSU banks were more affected, but even private banks were down about 2% for the week. What went up? Well, with oil under pressure and the prices of oil rising, naturally the energy index was the best performing index. Otherwise, a lot of the rate sensitives also suffered this week in terms of consumer durables, realty, and all of that, which is natural to be expected in the situation. Now, what to look forward in the coming week? Well, the geopolitical hangover will continue, and on a day-to-day basis, Mr. Trump's reactions, Iran's reactions are going to drive some amount of FI-driven volatility in the market, undoubtedly. But Monday is a big day because the Bengal election, while there are elections in 5 states, I think Bengal is the key because the BJP/NDA is seeking to come to power there for the first time, and exit polls have created a lot of excitement. So Monday is probably the one day it's the election results which are going to dominate the market, but soon after that I expect the market to get back to geopolitics and the earnings season. A lot of company earnings are due. A lot have come after Thursday market close also, but 25-30 companies have reported, and it's a mixed bag. There have been some good and some bad. So to that extent, this week is again an earnings heavy week, and there will be some news coming out from the Fed side in terms of data from the US on non-farm payrolls and all, which could give direction for the future. So there will be volatility in the market, but I think that given the fact that I feel that we are closer to a bottom, and this average around 24,000 seems to be holding up from a Nifty perspective, and mid and small caps are showing a little more resilience. I think that the DIS support will continue. So to summarize, I feel that for the market to touch new lows, we need some very bad news on the war front. But for the market to rise, we will obviously need very good news on the war front, because only then can you expect FIs to change their view. So the currency is, of course, an important factor here, because while the currency is hovering around the 95 levels and may again end during the week past 95, it's the forward currency, right? 1 year rate. And last I saw, the premium for 1 year was 342 basis points. So add that to the current short spot price, we're looking at a 98 plus rupee by the end of 1 year, which will affect it. Now, naturally, pharma did bit well this week, partly due to that, but also because of the big acquisition announced by Sun Pharma, which helped the sector to be positive. But IT was under pressure this week despite the rupee weakening. And that means that fundamentally, all the IT companies in their quarterly earnings analysis, as they discuss it with the those who participate in this call, haven't been able to give a really satisfactory answer as far as the tackling the AI or taking advantage of the AI. A lot of them are talking about AI. Nobody's ignoring it, but you need a very strong set of responses, which the corrections are showing that it's not. So to that extent, some IT companies are also disappointed in terms of the guidance. So very, very hard to go and say, okay, rupee is going to weaken, so the export-oriented IT and pharma will do well in the coming week. So not a time to pick sectors. Stick to diversification, but do not forget to buy. You have to keep buying small amounts all through this volatility, because let's face it, this is not going to be a never-ending war, because of the fact that there's pressure on Trump from the gasoline prices, his opinion polls. The Congress is questioning. Officially, they have said the war has ended to the Congress, because beyond 1st of May, they cannot continue without fresh Congress approval. So he switched to an embargo, which is not war in a sense. So if you look at it, I think that everybody is looking for a face-saving way to say that we have won the war, whether it's Iran side or America. So it should end. It may, they may drag out for a week, 2 weeks, 3 weeks more also. But for situation to worsen from here, we'll need some extraordinary stuff, which you cannot deny. The probability of something happening, America putting boots on the ground, it's a non-zero event. Some amount of probability there, so we cannot rule out that risk. But barring that, I think more or less my answer is that FIs have continued to be selling, but they have come to terms in terms of one day there's bad news, they sell about 8-10,000 crores, other days about 1,000-2,000 crores. But DIS should, as they've bottomed out in terms of their profit booking and now starting to deploy, should continue this week to support. So I would encourage retail investors with a medium-term outlook to continue to keep allocating in a diversified manner, little by little, to the market. So my position there doesn't change, and do not try and hunt for sectors. A lot of retail stock pickers are trying to buy the companies which give good results immediately and other companies in that sector. Well, that could be hazardous, because the next day itself another company in the same sector may report a worse result. So it's unpredictable time, but retail direct traders will do what they want to do. My advice is not for them. My advice is for medium-term investors, right? So let me reiterate that, and I'll continue to give my daily updates as far as the war in the markets during the coming week.